Hello and welcome to the inaugural episode of the Ontario Trucking Association's Market Watch video. I'm David Bradley and I'm president of OTA. Back in 2008, OTA launched a quarterly electronic survey of the motor carrier industry in Ontario. It was designed to give us a picture of how carriers are feeling about the future, their optimism or pessimism for the industry, their outlook in terms of volumes, capacity, and costs. Now let's take a look at the first quarter of 2012 survey. First, in terms of general optimism, after 3 months of a decline in optimism, we saw a majority of carriers reporting, in fact 65% of them, reporting that they were optimistic about the coming quarter for the industry. That's good, and I think that's a reflection of overall economic activity, but it's well off the peak of 73% that was recorded in the third quarter of 2010. What's interesting, though, is this increased optimism doesn't seem to be matched by any sort of spectacular growth in freight volumes. In fact, what we have is a flattish outlook in terms of volumes, with most carriers in all three geographic regions that we look at, intra-Ontario, interprovincial, Ontario-US, both southbound and northbound markets, most carriers reporting that they don't expect to see very much growth at all in the coming quarter. Another reason why I think we have relatively strong optimism, despite the fact that freight volumes appear to remain somewhat sluggish, at least in the first quarter, is because we have a semi-equilibrium situation with regards to the capacity of trucking service available and the amount of freight that the economy is generating. As a result, when I talk to carriers these days about how things are going, most will say, okay. And the reason for that is, again, there is a better balance between freight and capacity, certainly better than what we've seen in a long, long time. The issue for the carriers, I think, is whether that equilibrium is going to remain in place. And I think the chances there are that we're going to see capacity tighten as we move forward. I mean, we're seeing relatively tighter, at least balanced capacity at a time of rather slow growth. Any uptick in growth, and certainly we're starting to see some good economic signals coming from the US, would suggest that capacity will tighten in the months going forward. And that too is reflected, I think, in the survey, not in a major way at this point, but certainly moving in that direction. Now, in terms of the profit levels, this will take some time to filter through, because at the same time as we're seeing a tightness in capacity, relatively slow growth in volumes, we are seeing all the major cost components across the board, whether that's labor, equipment, etc., moving up, and in some cases quite significantly. I think the challenge for the industry going forward is how it's going to manage capacity. And some might say that, looking at our historical record, we don't have a particularly strong track record in this regard. But I think that the recession was felt so deeply in the industry that there is a higher level of discipline that has been in the marketplace in the past. However, as the economy starts to kick in again, and again the signals are now more positive than they've been in a long, long time, it'll be interesting to see how the industry copes with that challenge and the constant pull to grow and at the same time maintain a healthy bottom line. Thanks for watching. As I said, this is our inaugural episode of the Market Watch video blog. If you want more details on the survey, please go to www.ontruck.org and you'll find it all there.